Hey everyone, welcome back to another Behind the Hype. My name's Ryan, and today's session we're covering Treasury Explained. So some quick kind of background to what we'll do today. So Behind the Hype, we tackle different topics in fintech and kind of demystify them, take away the overhypedness behind it. The way the session will work is we'll have a presentation and then we'll have room for Q&A at the end. To ask questions, you can do it one of two ways. So you can either ask in the comments section below, or you can ask via slido.com using the code #hype, HYPE, and them questions will be anonymous and we'll cover them at the end of the session. So I'm going to pass over to Shireen, our Innovation Director based in Paris, to introduce the session.
Thanks a lot, Ryan. Hello, everyone. Today, we're really excited to have Guillaume Spay as a special guest. He will be introducing us to Treasury, how banks' treasury work, how a mid-sized bank is organized, and also the role and objectives of the bank's treasury. A quick intro to Guillaume. So Guillaume is a global solution lead at Finastra. He's been working with Finastra since 2015, focusing mainly on treasury and e-trading. He has also 20 years experience in short-term interest rate trading and has been working with multiple financial institutions, including Rabobank, Bank of America, Bank of Tokyo, Mitsubishi. He also holds a master's degree in bank finance from Université Paris Dauphine. So yeah, we're really excited to hear from you, Guillaume.
Thank you, Shireen, and welcome everybody. Thank you to being here for this Behind the Hype session. So yes, the theme today is treasury, and actually we all have a bank account, but we don't know what happens behind the scene. So it's let's take this hour to look at it. So the agenda today is made of 4 parts. We'll briefly go through Finastra, and because obviously we have a lot of solutions for treasury. And then we will go around and we'll look at the purpose of the treasury. We will look at the different roles and functions. And finally, we will look at how innovation can change what happens today in the treasury. But let's start with Finastra. So as you know, we are a big vendor in terms of banking solutions. And what is interesting is that we have a very wide breadth and depth of integrated solutions, and which means that we are very well positioned to talk about treasury, because obviously all the systems go back into the treasury. We'll see that later on. The good thing is that we have sold solutions all over the world, and we can have a touch and a feeling of what happens in every single country, and we can become regional as well. And then obviously we have many treasury clients all over the world. So we have close to 700 clients. And what is interesting is among our 3 main treasury products, which are called Condor, OPIX, and Summit, those products, those solutions at Finastra are or belong to the top 10 of our biggest solutions. So really, we have a big footprint in that space, and that's interesting at this stage. The other thing, and maybe a couple of figures, is that obviously you can see that Finastra is powering 8% of the daily FX trading. It's quite huge when you think that every day you have $6 trillion traded. So that's quite a big figure. We have as well, we are trading, or we are processing 9% of daily IRS's volumes, but above those figures, and so there are plenty of other metrics here. What is interesting is all those cash flows, they are in the end managed, looked at, paid. They are going through the treasury. So the treasury is really at the center, the heart of the bank. And this is what we're going to see right now. So I would like to look at now the the purpose of the Treasury. And so what it does exist really. We are talking about Treasury. We know that in every single corporate there is a Treasury function, but we cannot imagine really what happens within a bank. And to start this, I would like to bring a bit of background and perspective. And so how does a bank work? So obviously there are some clients. Those are individuals like you and me. You have small corporates that could be the bakery or the corner shop at the end of your street, or that could be bigger corporates, even the likes Apple or whatever company. And obviously, you have some departments that are devoted to each kind of clients. So you have retail banking, you have the corporate commercial banking, you have the investment bank. But what is interesting to know is that actually the cash flows, what is traded, what is sold, what is loaned, what is deposited with those departments always go back to one single point within the bank. That's the Treasury. And within the Treasury, so you have the management of the cash flows, you have the management of the risk coming from those cash flows, you have the management of the collateral, and the function that we are calling asset and liability management. And we'll see at a later stage what it is exactly. But when you have the aggregation of all the cash flows coming from those three parts of the bank, what happens? Actually, the Treasury is made of different small parts. Those small parts are split between what we call the front office, the middle office, and the back office. Front office is where you find the sales and the traders. The back office is where everything is processed, so it's the operations side of it, and the middle office has much more the control of everything that happens. It would not be able to work without the external world. So you have external world on the left-hand side, but you have the external world on the right-hand side as well. With the regulators, they are managing and providing guidance for everything banks are doing. You have the other banks and the very important interbank markets, so what banks are trading between themselves. And then you have the market themselves, so that can be the equity market, that can be the bond market, that can be the money market, that can be the FX market. So that those are many markets, and all the banks do have access to those. And if not directly, they will have access through other banks, and that's why you have the interbank market that is very important. Now, depending on the size of the bank, you may have sometimes what we call the corporate and investment bank. And this is where you can find pictures of the very big dealing rooms. So just to give you an example, when I was at Bank of America Merrill Lynch, actually just the dealing room in London was made of two floors, and each floor was 900 people. So that was pretty huge, and that was the corporate and investment bank. So you imagine big banks, you have big floors. Now tier 3, tier 4, tier 5 banks, the Treasury can be the dealing room by itself, and it can be maximum 20, 40 people. So that's where you see the scale of the banks. And talking about scale, actually, what is quite interesting to see is that the Treasury function, the Treasury role is something that is evolving with the complexity and the size of the bank, and its perimeter as well is evolving. And well, if the perimeter of the Treasury is more or less the same in every single bank, actually it can only slightly differ depending on the country or depending on the size of the bank. You always have the same functions inside the Treasury. But here in this chart, what you can see is that it's the evolution of the Treasury. And at the very beginning, let's take the example of a very small commercial or retail bank. Actually, you will execute all the Treasury functions within the core banking system. At some point, when you grow, when you provide more loans, mortgages to your clients, you want to have an independent Treasury with an independent system. And then because you are growing, then the regulators are coming, and this is where you have to become really trustable. You have to become compliant. And then obviously, very often, because you are growing, you want to have a different offering. So this is where you have to think about your strategy. And because you are growing, next stage would be the automation. What can I do to become more automated? And then you have the ultimate treasury, I would say, which is really leadership stage. And this is, again, where we come back to what I said earlier, is that's where it's the point where the treasury is the heart of the bank. It's pumping money into everything that the bank is doing, but it's not only pumping money, it's actually looking at all the regulation, all the compliance, all the automation, everything that happens within the bank. So the treasury function really is related to every single part of the bank. And when you are withdrawing money at an ATM, actually it has an impact for the treasury. So this is a very simple chart of how the treasury could be organized within a medium-sized bank. And because it's a medium-sized bank, this is why you see the CEO and the board present at the top of this chart. And just below them, you can see the CFO, Chief Finance Officer, and the Chief Risk Officer, the CRO. And the head of treasury is just below them. What is important here is that those guys, those 4 guys plus the board, and at some point the head of market is the bank has a good size enough. They are making what we are calling the ALCO. The ALCO is the Asset and Liability Committee. They are taking every strategic decisions, and in terms of strategic decisions, actually, they are telling the kind of thing like, okay, we need to provide more mortgage because there is a good margin with mortgages. So we need to increase our market share there. Maybe we will decrease our market share with small corporation because actually the return is not that good, and so on. So they will decide the allocation of the capital. If we look at the green part, so the head of treasury and what we have below, the ALM and money market, those are really pure treasury functions. So those guys will look at the 6 functions that we will look at just in the next slide, or slightly after, actually. But they will manage the money for the bank. So they will manage as well all the assets on one side, the liabilities on the other side, and they will try to match them so that the bank is not at risk. The role of the treasury is really making sure that the bank is not at risk and can be live in 6 months, in 1 year, in 3 years, in 5 year time. Depending on the money market side, so the traders, the people that would be in the dealing room, you have a couple of traders. They can trade foreign exchange. They can trade fixed income, so the bonds. The bonds can be either corporate bonds or government bonds, and interest rates. So those can be very vanilla derivatives such as interest rate swaps or FRAs. And if the bank is big enough, then you can have other functions and pure trading, so market making capabilities where you would look at commodities, equities, credit on top of the other activities. So that's a very simple org chart, and obviously, if you have questions at a later stage, I will be able to answer to you on this. But so, still looking at the perspective, the background of the treasury, I think it's important to look at the challenges. What happens? What they are looking at on a day-to-day basis, and maybe we'll provide a bit of light as well with this COVID-19 crisis that is happening right now. So we have identified three challenges for the banks and for the treasury inside the bank. The first one is really growth. So how can they help to grow the bank? And here we could say there are 2 ways for a treasury. So either they grow high volume products, very simple but high volume products such as FX, or they grow low volume products where there is a much bigger margin, and here that can be derivatives. But in the end, what is interesting is that the banks and the Treasury, they want to find ways to differentiate themselves from the other bank, from the competitors. They want to meet the client expectations, either clients being either individuals or corporation. And very often there are new opportunities. So again, for example, with COVID-19, they had a role, and the Treasury were really deep in that. They had a role to distribute loans very quickly to a small corporation to make sure that they would still be alive with the crisis. So that's one of the challenges for the Treasury. The second big challenge that we can find for Treasury is actually that there is a big operational side, and this operational is very often it's very manual, so it's very costly. And when you have systems, actually, many banks have built big infrastructure that is made of multiple systems, so it's very costly in terms of maintenance, and very often it's pretty rigid. And the last one is about the regulation, and this regulation has been a major problem for banks since the last crisis in 2008, and it's still continuing to be a problem because they need to follow the regulators, and they need to be able to apply the latest change. And there has been with COVID-19 many changes. But so in the end, so if we look at the challenges for Treasury and for banks, all in all, there are problems with revenues, so and the opportunities of making more money, and this is very actual with negative rates, for example. They are very often they have a problem with their business model and the target operating model that is behind that business model. And the last one is a very often a question of reputation. So LIBOR has been a big theme for fines and reputation, but then you can have many more with and many fines. So talking about COVID-19, I think it's important to talk about it right now because it has a big impact. And just on the previous slide, we talked about the evolution of the regulation. And actually, one of the first impact of COVID-19 is the evolution of the regulation. Okay, if we look at Basel III, for example, so the Feds and the FCA in the UK have changed the regulation, so that it's going to be easier for the bank to lend to the small corporates. So that's one of the things. On the other hand, if we look at LIBOR, they are really staying in the same position, and they are telling the banks that they will not change the end date of 2021, end of December 2021, to make the transition to the other rate, so the SOFR rate, for example, in the US. So when it comes to structural change, they stay exactly the same. When it comes to adapt the regulation to make sure that actually the banks can help the economy, then the regulators are able to change the rules. And this is where the banks need to be very agile. And again, because I was saying that the bank is at the heart of the Treasury, then the Treasury, they have to be very agile as well. So that's something that is pretty interesting. In terms of other streams in terms of regulators and regulation, I think it's interesting to hear that the PRA and the FCA in the UK has told, I think no later than the 29th of May, that they've told lenders not to assume that extending repayments holidays with the crisis will increase their risk of losses. So definitely they are telling the banks, okay, there is a regulation, forget it, and we'll make sure that you will go through your compliance tests because we want the economy to work. So they don't want the bank to restrict the ability of credit. So that's an important thing. In terms of remote working, well, there is a lot of people saying a lot of things about remote working. We are working remotely. I am home, so it has changed for me. But we don't really know what happens. And I had a chat with one of my friends at BNP. He's a trader on the fixed income desk, and he was telling me it's very simple at BNP in London. You have 75% of traders in the dealing room right now going to work every day. But in terms of operations, you have nobody from the back office and nobody from the middle office. So the coverage rate is actually around 25% in the dealing rooms in London, which is, I don't know if it's surprising or not, but it's a thing. So there is a reflection behind that about yes, how does it work remote working, and there could be some reputation risk if people know that actually there is nobody maybe in the living room, or compliance is not made properly, and there is no supervisory done at home, and so on. So that's an interesting topic. In terms of risk management, obviously COVID-19 is important. So banks will have to look at the liquidity, the credits, trading, and so on. So those are plenty of things. The infrastructure, there's going to be a change. There is a thinking that everybody can work with cloud. It's not always the case. Data management, there will be more change in the way Treasury are analyzing the data, their clients, what they are doing. So a change of methodology of working, and obviously customers will differentiate how they are, or will have new habits for working. In terms of the bank's clients, again, corporation and individuals, we are always back to those two types. There is a need for working capital for corporation. For some individuals, there will be need for money as well, with maybe some unemployment or new needs. So it will change the way the Treasury will have to look at how they do allocate their capital. So there will be new strategies put in place. There will be a new analysis in terms of solvability, in terms of debt level, in terms of how we can use the state aids to make more business. And for us, Finastra or other vendors, obviously there is this move towards cloudification, platformification, and maybe new ways to work with our clients. So those are briefly what I can see with COVID-19. Obviously, it's impacting the treasury function, because they will be deeply involved in those changes. They are at the center of everything again. So let's go deeper into the role of the Treasury. What are the different functions in there? And here we have a bit of glossary. I won't explain the terms. If it's not clear for you, I'm happy to answer the questions at the end of the session, obviously. But I hope that you will have a clear understanding enough for this. So the Treasury is at the heart of the bank, and I'm always back to that. So the first thing that the Treasury is doing is managing the bank's money. Exactly the same you are doing with your own money. You are managing your own money. So you have a bank account, you are managing your own money. You are your own treasurer. So that's the first thing. The second thing is they are covering the cash management, corporate finance, so the different functions that we can find inside the bank, financial risk management and the regulatory. So they can see all the sides of the business, from risk to cash, to finance, to compliance. But we have to never forget that the ultimate goal of the Treasury is and remains profitability. So they are here to make money. And actually, when you listen to the results of the banks, the quarterly results from the US banks, English banks, European banks, or whatever, actually, we are hearing very huge numbers. And those numbers, they are mainly coming from the treasury function, mainly, because this is where everything comes back. So you obviously you have the fees from the investment bank, you have the money made by the traders when they are market makers and so on. But the biggest part is coming from the treasury, from lending high and borrowing low. So that's their role, and this is what they are managing every day. So how are they doing it? What are they doing on a day-to-day basis? So there are 6 functions, and you could imagine them built as a pyramid. So at the bottom of the pyramid, you will have the function that takes the most of the time every day, but that will be the least strategic. And at the top of the pyramid, you will have what is very strategic. And so the 6 functions are the following ones. So the first one at the base of the pyramid is the funding function. And we will go into the details of each function afterwards. So the first one is funding, so making sure that you have enough money. The second one is pricing, providing a good price to every single department, every single part, every single business of the bank. The third one would be the liquidity management. So it's not only it's funding, but with a longer horizon. And then the fourth part will be the market risk management, and I will explain what I include inside market risk management. And then it will be no surprise for you. We have the compliance and regulation, so how to follow and the regulation and making sure that you can answer the regulators at any point in time. And I said at any point in time, every day, every second. And the last one, very strategic. So at the top of the pyramid, we have the capital management. And this is where the profitability is sitting, because this is where you decide how much money you will allocate to which part of the business or which type of client. So let's go to the funding. So what is funding? And very often we are saying, and that was actually at the birth of banks, banker could lend money because they had deposits, and there is a motto saying, is it deposits that are making credits or credits that are making deposits? So at the very beginning, everybody was thinking and saying, well, deposits are making credits. Actually, now it has reversed, and this is why you can see on the screen that it's starting from lending, from the borrowers lending, and then it's going to the deposits. It's actually, the more you lend, the more you have deposits, because there is a chain of money that is creating, and it's the money multiplier that I'm talking about right now. But so in that funding function, what does it mean? It means that at some point you lend some money that you don't have, or you may not have. So you need to find it elsewhere, and that's the first role of the funding. Okay, so the funding is to ensure the bank has enough funds to cover the daily outflows, everyday daily outflows, plus the regulatory requirements, plus the contractual agreements, and this at the lowest cost every day. So the funding is really looking at the money necessary to run the bank at the lowest cost. So you could tell me, okay, you have some money from the capital, you have some money from the deposit, but the money is coming as well from the central bank. So the banks are borrowing money at the central bank every week in Europe, for example. So it's called the MRO, main refinancing operation. Or they can find the money with other banks, okay? And this is what we are calling overnight funding, so from one day to one another. So how do you fund? Then you would need multiple instruments. So the first instrument we can think of is the cash. Okay, I borrow to another bank or to the central bank 1 million euro, 10 million euro, 1 billion euro, whatever. And then you can think about, okay, there is not only these cash instruments, but I can use securities. Maybe as a banker, as a treasurer, at some point in the past, I had too much money and I bought some government bonds. So those government bonds, I can lend them to somebody else, and I can get some cash instead. So that's that's a repo refinancing. That's securities, using securities. So the first tool would be cash. The second tool would be securities, fixed income securities, and the third instrument would be FX. FX is a very, very efficient way to fund yourself from one currency to another currency. Imagine that you need money in dollar and you only have euro, then you need to execute an FX deal, but you want it only from one day to one another, so that's going to be an FX swap, for example. So this funding function, you can think, okay, I can do it only for today. But if you want to be efficient, then you will maybe fund not only for 1 day, but for 2 days or 3 days or 1 week, 1 month, 3 months. So what is interesting in that funding function is not only you have a choice of instruments, but you have as well a choice of tenors or maturities. And in the end, you need to measure your performance. I was just saying that the Treasury has to be profitable at any point. And to be profitable, you need to measure yourself. So there is a good instrument to measure yourself is the risk-free rate. We are talking quite a lot about risk-free rate right now because it's going to be the new reference rate for everybody, and it's going to replace LIBOR. Actually, it's been used by bankers and treasurers now for almost 20 years, risk-free rate. So Sonia in the UK, for example, started in 1996, and it has been used as a performance measure since. So that's interesting. So that's the funding function. Now, so I said the money to fund yourself, where is it coming from? Your capital, the deposits, are the instrument that I just talked about. Just to give you an example, how it can evolve over time, and this is the funding mix of Goldman Sachs before and after the 2008 crisis. If you look at it before the crisis, 2007, so on the first bar on the right hand side, it was only a small portion, so 15 billion, and there were no deposits in their funding mix. It was a pure investment bank, and they had to issue some debt, so issue some bonds or issue some capital to get money and to run the bank. They bought part of GE Capital in 2014, and since then they have a deposit part in their funding mix that is quite huge. As you can see, it has increased over time up to 2017, where the deposit have reached something like $100 billion. So it's a very cheap way to fund yourself. You just need to have retail clients and to make them happy. So it's easy and not easy, and not easy at the same time. But it's a very cheap way to get money, because you don't need to go every day in the market or to the central bank or to the interbank market to get that money to make sure that you can run the bank. Okay, so that's a good example at Goldman Sachs. When it comes to pricing, so that's the second part, the second floor of our function of the Treasury. So first one was funding. The second is pricing. What do I mean by pricing? So the first one is, and you remember I said different size of banks. So the smaller banks, you will only have at the front office the Treasury function, and then you may have some corporate clients calling the Treasury. So the treasurer or the corporates calling the Treasury, the bank, and asking, okay, can you lend me some money for 1 month? So this is what I call direct pricing. It's made by the front office, and the trader will be able to provide a price, and he will be able to say, okay, 1 month dollar, I can lend you $1 million at, I don't know, 0.35%. So that's going to be the price. So that's direct pricing. And actually, this price will coming from the feeling of the market first, obviously, but what is the credit risk of that particular client? What is the risk of rates going up or down, and so on. So plenty of things. The other part of the pricing from the Treasury is when they provide some funding to the other department of the bank. And so, for example, the branches. So you, me, as an individual, I want to buy a house. What will I do? I will ask for a mortgage, and at my branch, they will tell me, Guillaume, if you want to borrow money for 20 years, and if you want to borrow £500,000, then it's going to cost you 5% on a fixed rate, or LIBOR plus 300 basis points, so that kind of thing. Actually, those prices, they are coming straight from the Treasury, because they are in the knowledge of how is the market, how expensive it is to fund, and that's why the funding is the first function. So how expensive it is to fund, how risky I may be, how the shape of the interest rate curve can move as well, and so on. So that's the indirect pricing. And how does it work? It works through what we are calling the FTP, fund transfer pricing. I don't want really to go into the details of the fund transfer pricing, but obviously you can imagine that if the bank has to lend some money, then it would be a markup that is added on the interbank market price. Now, if the bank has to borrow, it will be a mark down on what they can find or where they can relend that money into the market. And that's a process that is quite complex, actually, FTP, because when you think about the deposits, you never know for how long you will have the deposits. And then you need to have a kind of replication curve to price it and to imagine what is the cost of those deposits if you imagine that there is an interest rate. So that's a very interesting and complex process, FTP. Now let's look at the third floor. First one, funding. Second one, pricing, which was derived from funding. The third one is liquidity, the liquidity management. So this is, I would say, one of the most important things for a treasurer. Why that? Because there are a lot of reasons why a bank can go bankrupt. But if you look at the case of Lehman, Bear Stearns, Fortis, Northern Rock, and there are many others during the 2008 crisis, they all went down because of bad liquidity management. Actually, they lent a lot of money for long periods, long maturities, and they were purely relying on funding, on borrowing money from one day to one another. And at one point, this model didn't work because they were not trustable anymore. So the liquidity risk, per se, is the inability to meet your obligations as they come due. Okay, and there are three types of liquidity risk. So the first one is illiquid assets. So just a quick example, I want to eat, I have no money in my wallet, but I have my car. Okay, can I sell my car to buy me a sandwich? No, I will. It's impossible. My car is relative to the sandwich is an illiquid asset. So that's the first problem. The second one is about illiquid markets, and as soon as there is a crisis, markets become illiquid, and that's why, for example, at the beginning of the COVID-19 in Europe, markets went straight south because it was illiquid. There were no buyers, so everybody was unable to liquidate the assets or at a very low price. That's why it went down. And the last liquidity risk is about credit problem. It's about trust. So if we take back the example of Lehman, the word of mouth came from one day to one another, and everybody in the dealing rooms was saying, okay, Lehman, it's not sure they have money. If they borrow you some money, it's not sure they will give it back to you tomorrow. So credit problem, trust problem, confidence problem, inability to obtain the funding. And that's very, very important. That's critical for a bank and critical for a treasurer. So that's the third one in my pyramid. It comes on top of the funding and the pricing, and we will look at what banks are using as instruments to manage. Just before that, so what do you need to do to manage properly your liquidity? So first, you need liquidity is always an equation, or it's always a balance between how risky you want to be, how profitable you want to be, and how liquid you want to be. Remember, liquid is about having the right asset at the right time and being trustable in the market and being in some market that are liquid. So if one of those three is not answered, then you are in a difficult situation. So the treasurer and the liquidity manager, they always have to think about those three things: liquidity, risk, and profitability. And maybe sometimes I would be more profitable, but if I am illiquid, then I am putting the bank at risk. That's one thing. So the corollary of this, of the risk and profitability towards equity, is that you need, at every single point in time, you need to optimize your assets. So you need to be able to look at if the assets you have are the right ones. They are very effective in terms of costs, and actually they are very effective in terms of liquidity and profitability. And from here, you can derive what is the asset and liability management, because the assets are long-term things, liability as well. So it can be 1 week, but it can be 10 years, 15 years, 50 years. So you need to match them, or to make sure actually that if you have a mismatch between your assets and liabilities at some point in time, it's in a long time enough, and you will be able to manage it over time. And from here, we will see that the regulators have put a lot of ratios in place to make sure that banks are managing their liquidity properly. But what does it mean for the treasurer? Actually, it means that they need to have in place the right framework so that they can identify the liquidity and the assets. They can measure them in terms of liquidity and in terms of risk. They can monitor it from one day to one another, and actually they can control it, and they can audit it, and they can report it to the regulators. And you have to be able to do this in any circumstances. So normal times, business as usual, or stress times, and we are in a stressed time at the moment. So I can tell you that in banks, people are looking at all the scenarios to make sure that they will remain properly funded over time. And it's not because the central banks are putting a lot of money in the markets that they are sure to be always liquid. So that's a very, very important topic, liquidity management. And I will never stop talking about liquidity management. What are the tools the metrics to manage your liquidity? So usually the most used ones are the liquidity gap. So it's a time ladder with your assets and liabilities, and you look at how much you are positive or negative. Obviously, you need to have some buffers, and those are the liquidity reserves. You need to look at as well very often what to measure versus your maximum capacities. So where you can either borrow what you have in excess, or borrow what you need, or lend what you have in excess, and then you have ratios and so on, which are a bit more mathematical. So those are instruments that are used day in, day out by treasurers and by middle office in treasury functions at medium banks. The liquidity gap, for example, here you have an example, and you would look at some here it's an 8-week limit, but you will draw a chart of how the profile of your asset and liabilities, and obviously you should be able to stress those inflows and outflows over time to make sure that you will not go over your limits. Now, and I talked about the paradigm of liquidity, risk, and profitability. And I said one of the good ways to manage your liquidity is actually to have a buffer, to have a reserve. And this chart is particularly interesting. It's coming from BCG. It's a study from 2017. And actually, it's calculating how costly it is to have a liquidity buffer, to keep money in reserve for your liquidity management. So the more money you have in reserve, obviously, the safer you are. But actually, the more money you have as well, the more costly it is. And actually, you can see that it's costing quite a lot in terms of return on equity. If you look at the right-hand side of this chart, so if your buffer, when your buffer increases, actually it can cost you as up to 2% in terms of return on equity. So it's quite huge, and there is a direct report between the two. So again, liquidity management is one of the most important things for banks, because the profitability of the bank will depend of that ALM. The next floor is the market risk management. So I know that very often people are saying market risk. It's about the capital, it's about the balance sheet, and so on. As a trader, I can tell you that for me, market risk is what I have in terms of interest rate risk, in terms of FX risk, and so on. So we will look at them right now. So what is the interest rate risk? So it's how much you can lose or make when you are in adverse movements in terms of interest rates. So if you are a lender, if you are a net lender of money and the interest rates are going up, or net borrower, and for example, the interest rate curve is going down. So the interest rate risk is part of the business, and since banks were created 500 years ago, they were always interest rates risk. So that's really normal part of the banking business, and every treasurer, they obviously they manage their interest rate risk. Now, obviously, as everything in excess, it's not good, and this is why your treasury system, traders inside the treasury need to look at their interest rate risk. So this can come from the interest risk from 4 different things. The first one is what we call the repricing risk. So the repricing risk, what it is, simply put, is when you have a reset. So if you lend money at LIBOR, for example, to talk about this one, so LIBOR is reset every 3 months. So maybe 3 months ago, I could have lent some money in dollar at 1.5%. Now for the next 3 months, and today the fixing would have been about 0.25. So in terms of repricing risk, it's quite a huge risk, and you need to know as a treasurer, as a trader in the treasury, how much repricing, how much resets you will have in the coming days, months, quarter, and how it will impact your revenues. The second one is obviously the shape of the curve. So it's the yield curve. Okay. Is it ascending? Is it descending? Is it a U shape? What is it? Is it going to be flat? Is it negative? And negative is a big topic at the moment for European banks, for Swiss banks, for Japanese banks. So all those countries are in negative. There are talks about going negative in the UK. US, they said that they don't want to go into negative, but actually the overnight rates and in the interbank market is negative as well. So it's very risky, and it causes some problems in terms of profitability for the banks and the treasury again. So very important part. The basis risk is when you want to hedge, for example, yourself. So you have lent some money at LIBOR with a 3-month reset, but you wanted to hedge yourself. You have an imperfect hedge, and then you have borrowed money with a 6 months reset. So you have a 3 months versus 6 months basis risk. And obviously, the shape of those two curves are different, so you may lose or make money. And the last one is optionality. Imagine again, you are a treasurer, you have suggested some pricing to your network of branches for the mortgage, and so you have included some optionality, so a repayment. So repayment is an optionality. So it may change actually over time with repayments. If rates are going up, people may repay earlier than what you think, and it will change the shape of your balance sheet. It will change the shape of your liquidity profile. It will change the shape of your profitability. So those have to be taken into account by the treasurer. So that's about interest rate risk management. So how can you hedge yourself? How can you make sure that you are not losing too much money against it? So the first things are to assess. Before talking about the tools, let's assess. So how can you do that? So the first one are the market value perspective. So you have your gap analysis, like the one you have, for example, with your liquidity gap. You can have an interest rate gap. So how much I am a lender and how much I am a borrower, and I will look at the difference. You would calculate your duration. You would calculate your PVO1, your value at risk. All those instruments are helping you to measure what's your dependence towards the interest rate risk. You have in terms of management ratios, so they are a little bit more looking at the bank in its entirety. And again, because the Treasury is at the heart of the bank, they have a look at everything, so the global business. So they are able and they need to look at those as well. So you have the earning at risk, you have the duration again, and you have the global gap analysis. So it's another stream. And then the last one, if you read the bank statement, the financial statement of a bank, you will always see NII and NIM, net interest margin, for example. So it's how much you are making with all the money you have borrowed and all the money you have lent for the bank on its entirety. So that's the NIM. So those are interesting things to look at and to assess when you are looking at the bank and how good the work of the Treasury is. In terms of instrument, I can see it's missing there, but how can you hedge your interest rate risk? So the first instrument to hedge your interest rate risk is obviously to make the opposite operation as the one you've done. But imagine that every time a bank is providing a mortgage to a retail client, an individual or a corporate, they will not do exactly the same deal, the opposite side, because the amounts maybe will be too small and they want to aggregate and they want to scale and so on. So actually they are using other instruments, they are using derivatives, they are using swaps, and they are managing all of this I would say in big numbers. But the main instruments are derivatives to manage the interest rate risk. You can use options as well and so on. In terms of FX risk, so exactly or more or less the same as the interest rate risk, that's going to be the risk to earnings. You put a mismatch in your currencies. Okay, so if you are long a currency and it's going down, obviously you're gonna lose money and the opposite. So but more interestingly, the FX market is a global one. It's a huge one. It's the biggest in the world, 6 trillion a day, as I said earlier on. So you really, as a treasurer, you need to be very careful of your FX risk. And so treasurer, they really need to look at interest rate risk and FX risk at the same time. So you have two main ways to measure your FX risk. Obviously, is one, how much cash you have in that currency. So it's your net open position, and you can look at it per perimeter, per legal entity, or for the whole bank. Okay, so that's one thing. And the second thing is obviously you need to look at kind of time ladder with your FX exposures. So how much of that currency will I receive by X days? So the 10th of August, will I receive some dollars, some euros, some sterling, some dollar sing, whatever? So I need to know, and maybe I will need to hedge myself against this. And I will come back because I am able to measure my FX risk. I will be able to fund myself and go back to the step one of my pyramid. So that's interesting, but it's part of it. You always, as a trader in the treasury, you always have your risk under your eyes. In terms of instruments, you have obviously the cash markets, and then you will have the FX forward. So I can exchange one currency versus one another at a certain point in time. I can make a swap. So for a period, so for 1 month's time, I exchange one currency versus another one, and then you have options. So those are instruments that can be used to manage your FX risk. Now we are going to the next floor, and it's becoming more complex. So you've seen we started with something very simple, so finding money on a day-to-day basis to make sure that I can run the bank, and now I am up to the regulatory compliance. And here, this is where it becomes complex, because this is where you it has evolved quite a lot over time. So not going into the details, but obviously it's split into different categories. So you can see that liquidity risk comes third here, and I will explain that. But you have the market risk, so interest rate risk on the banking books, for example. It's an advanced measure that has been put in place in the last 10 years. You have your value at risk and FRTB, so fundamental review of the trading book, which will be live now in 2023. So it has been postponed by 1 year. You have your credit risk, so how your clients are risky. So with the loans you have provided to them, and multiple measures, obviously from the least to the most complex. So PFE, for example. When it comes to liquidity risk, so those two are very interesting because they are very on the mind of every treasurer every day. So it's the LCR and NSFR. What does it mean? What does it stand for? So LCR is the liquidity coverage ratio, and NSFR is the net stable funding ratio. So the first one, liquidity coverage ratio, what does it mean? It imposes to the treasurer to have enough money to sustain all the outputs of the bank for the next 30 days. For the next 30 days, the bank needs to have enough money in reserve to sustain the outflows without any inflows. So that's very interesting. And it has been put in place starting in 2015, and now you can find it in every country in the world. The NSFR, net stable funding ratio, has a slightly longer horizon. So the first one, LCR, is 30 days. Net stable funding ratio has a 1-year horizon. And it's looking at all the inflows and outflows at the treasury level, and it imposes to match them in terms of maturity. So if you have 6 months outflows, you need to have 6 months inflows in front of them. So those two ratios, LCR and NSFR, they need to be over 100% every day, and they are followed very closely now by the regulators. And obviously, they are moving quite a lot with COVID-19 crisis, for example. Now there is, in terms of regulatory, there is, I would say, a big overall regulation that is called BCBS 239. So it's a very nice name. So it's a Basel regulation, number 239, and actually it's made of 13 principles, and they are talking about everything about the process you have to put in place, about the recovery, about the reporting, about the methodology of calculation, and so on. So that's very important. And as you can see, again, the Treasury is at the center of it. So the treasurer, they need to know about the funding, they need to know about the liquidity management, they need to know about the management of the FX risk, of the interest rate risk. They need to know about the regulation as well, because otherwise the bank will not be compliant and they will not be able to run the bank, very simply. So the regulatory compliance is made of those latest regulations that are named Basel II, Basel III, Basel IV. So now we are at Basel IV, but banks are implementing Basel III ratios. So Basel III ratios are the LCR and SFR. Basel II is IRBB, and it's slightly older. And Basel IV actually it introduces changes that limits the reduction in capital that can result from banks' use of internal models. So it's a bit complicated, but what you have to keep in mind is that the regulation is there to make the bank safer. And in the state of the regulator, a safer bank is a bank that has more capital in reserve. So obviously it has a cost. And again, we are coming back to the optimization. And talking about optimization, actually, we are now at the top floor of our pyramids. It's the capital management. It's the optimization of the capital structure. Or it's as well the weighted average cost of capital. So you need to be able to calculate it at any point in time so that you know how stable you are, how your profits are stable, how you can please your shareholders, and so on. And you will tell me, where is the Treasury here? Well, actually, the Treasury is the owner of the capital management, simply because they are part of the Asset and Liability Committee. You remember I was talking about it at the very beginning. So they are doing capital planning. They are able to diversify in terms of funding or in terms of allocating the capital or diverting the investments. They are looking at what are the opportunities in the market, and actually, if they have to raise some money, actually they will try to raise money in the part of the curve that is the cheapest. So maybe the interest rate curve have a shape where the 5-year is all in all slightly less expensive than the 10-year, relatively speaking, obviously. And then they will have to know about the investor demand. So again, the Treasury is at the heart of it. And the dependency is obviously the Treasury is dependent on the timing. Okay, is it the right time? And we are back to the liquidity management. They are dependent on the price and the conditions in the markets. And the loop of this cycle is the better you can fund, the better you can assess the cost of your capital, the better your credit rating is. So the better you are seen and trusted by the markets, the higher the returns, and the better you can fund yourself, and the lower are your costs. So it's really a virtuous cycle that you have here, and the Treasury is at the heart of it. So that's very interesting. And then you have other things that you would be taking into account in terms of capital management. So they are called the economic capital, the regulatory capital, the RORAC, the RAROC, EVA. So plenty of strange names, ratios that you can calculate. Just coming back to the economic capital, actually the economic capital would be the amount of capital you need to run your bank with a good confidence in terms of revenues and profitability. Well, the regulatory capital is what is imposed by the regulators to run the same bank, and very often you have a big difference between those two, and it has implications in terms of market risk, in terms of allocation of capital, in terms of defining what is your target and where you want to increase or decrease your market share. So those are the 6 functions of the Treasury. So I would like to finish this with a bit of innovation, and because I think the Treasury is evolving right now, even if we don't see it. So let's talk about innovation. How does it work, innovation? And so we always feel that innovation will change our life, but actually there is a difference between innovation and disruption. And if you look at banks and how they've been managed, how the Treasury have managed their actions inside the banks, actually the goal of banks have always been to serve or to service the individuals. So that's the backbone of every bank. It was valid 50 years ago. It's still valid right now. But if we are giving the example of different technologies, so we can think that before the 90s, banks were starting to use mainframes as infrastructure, technology infrastructure to run their operation. And so the mainframe was used for ledger, so it was for a question of trust. And the treasury services were localized. Everywhere you had, or every city you had a branch, you had a treasury function. So it was not very efficient. And then you had a second technology wave that came, for example, with the personal computers. And this is where you started to have the markets, the emergence of markets, the emergence of traders with capabilities of calculation that were multiplied. And so you had a change in the way the banks started to service their clients, not only the individuals, but the corporation. And we went into much more technicity. And that was the second wave of technology. The second wave of technology always starts slightly lower than the first one, because obviously you need to put everything in place, and then the curve is steepening, and then the advantage is weakening. And I would say now we are in the third part of a technology change right now. So now we are in a new wave where the scaling of the technology brings us full digitization. Actually, we had 4 technology steps. The first one was mainframe, second one was computers, third one was private networks at banks, and the fourth one now is cloudification, platformification. So let's try to see how it will disrupt the banking technology, the treasury by itself. So actually, it will have 3 main impacts. So the first one is obviously in the application management. I said at the beginning that Treasury, we are using tens of different systems. Infrastructure is very complex. It's a spaghetti-like infrastructure with point-to-point links between the different systems. So it's very difficult, not very efficient. So you will have a change in application management because everything should be managed on the cloud by external people. So it's externally serviced. The second one is optimization. So obviously in terms of costs and technology, it will go much faster, it will be much easier, and the banks will only look at the finished products, and the infrastructure will be managed by somebody else with systems run by agile service, I would say. And the last one is obviously automation. What we couldn't do or what we were doing before manually can be done now automatically, and algorithms are doing everything for you. So the innovation is moving everything for the treasury world, and there are multiple streams where we can see it will really impact us, and it will impact not only application management optimization, but as well automation. So the things that I have identified right now are, the first one is regulatory reporting. So regulatory reporting is one of the 6 steps of what Treasury and the Treasurer has to do. It's to report to the regulators everything about the bank activity. And it's complex because it's changing every day. I was saying that with COVID-19, it's changing. So they need to adapt, and you need to adapt if you are present for a bank in multiple countries, you need to adapt to the different regulation of the different countries. So that's one of the way where you can be serviced by an external company, by a smaller fintech that would be much more agile and specialized in that field. If you look at intraday liquidity management, so it's pushing even further what I said earlier. So I said liquidity management was important, but now we are looking at real-time intraday liquidity management, because your inflows and outflows during the same day can diverge, and you can have a lot of outflows in the morning and inflows in the evening. In that case, you cannot pay, so you are at risk. So that's another field where there are a lot of reflections about treasury management and innovation. But you can look at as well your transaction, your cost analysis. So when I am trading with client XYZ, how much money am I making? How much money am I making after 5 seconds, after 1 minute, after 10 minutes? Is this client, when he's trading FX, is it always making money? Is he losing money? Has he the right way? Are his amounts important, risky for me, and so on? So this is transaction cost analysis. And if you have tools for this, then you are better equipped, because you know exactly what to do for next time the clients will want to hit you. In terms of market risk, you can have advanced measures, going faster, calculating and aggregating better all your cash flows so that you have a better view of what you can do and better hedge yourself. You can have e-trading, and e-trading is reaching your clients. It's widening your franchise, the money you can make without having more people physically to call them. So it's how I can actually increase my benefits, my revenues, my profitability without increasing my manpower. And then the Salesforce workflow. So how I can automate at some point what I'm doing inside my treasury with my traders and with my clients. So how can I make sure that all the deals I have done, all the operations, they are booked correctly without any mistake, that they will be processed properly and checked, verified, paid, securitized, whatever you want. So that's the sales workflow. It would go from your clients straight to your processing and to the payments. And there are a lot of reflection around that. So that's the innovation that we can find in the treasury at the moment. And I have to come back to Finastra. I started with Finastra. I have to finish with Finastra, because you certainly know that we are very active in that space. So we have a platform that is called FFDC Fusion Fabric.cloud, and this is exactly what we are doing right now with our treasury system. So we are putting them on the cloud, we are opening them, we are making sure that all our client types with all our line of business can access different developers, so the fintechs, or developers, some system integrators, universities, other financial institutions. Everybody can develop into Fusion Fabric.cloud. Everybody can develop APIs and make sure that actually they can link all systems or treasury systems with other applications. That's we can access the new services provided by the fintechs. So this is the evolution of the treasury. And despite the fact that I said at the beginning that the treasury is more or less the same in every country, it evolves at different rates, and we are opening ourselves and we are opening the world for the banks now for the treasury. And so that's it for my my understanding of the treasury. So you certainly have some questions. Yeah, so Ryan, you're getting a little bit, but I can see the question. So when it comes to individual banks, so the banks are not publicly available because it's very proprietary, and it would tell quite a lot about how a bank is managed, how a treasury is managed. But what you can see when, again, you have to read the financial statements of banks, and they are providing you with indicators. Now, on those liquidity metrics, how they are calculated, yes, there are some books that you can find, and you can understand slightly better what is inside. So I can I can provide you with book names if you need it.
Thanks a lot, Guillaume. I really like the way that you summarize it with, you said it a couple of times, Treasury is at the heart of the bank. That's a quite good summary, actually, of what a Treasury does in the bank. It's interacting with all the other departments, and it's also key to the bank's revenue. I wanted also to highlight another thing that we can clearly see throughout your presentation, which is that it's actually a highly regulated business. We've seen a lot of acronyms, a lot of regulations, and it's it's quite shocking for some slides. And one last point, actually, on my side, I thought actually the COVID part of your presentation was really interesting. It's really cool to see the impact of the crisis and how the regulators and the banks have both adapted to the situation. I wanted also to mention an article that was CNBC, I think, with traders at Goldman Sachs in the US that were actually saying quite the opposite of what you mentioned about working from home. And they were saying that it was surprisingly, it worked really well. And they had all the tools they needed with Symphony and like trade management systems like the ones that Finastra provide, and Teams and all their communication tools. So it's really interesting actually to see how the trading job is evolving throughout the crisis.
And I think it's not finished. So I prefer to say, remote working. We don't really know what's happening. You know, in some banks they may have a certain way of doing it. In other banks they may have another way. Now you're telling me about Goldman, and I think the case of Goldman is no different from many other banks. So yes, obviously Teams is working, Symphony is working, so all those systems to discuss, to chat, to exchange informations, market data, whatever you want, it's working, and you can with a good Wi-Fi, you can access a lot of informations. Good guy for Treasury. But what is interesting is you certainly know that now for 10 years you cannot bring a mobile inside the dealing room. So when you're home, you can access your mobile and you can do whatever you want. So actually, it's the open door for a lot of problems, and the regulators have struggled quite a lot in the last 10 years to make sure that traders were not front running what was happening. They were not having hidden secret agreements between traders to manipulate the markets. And this is the danger of working from home. So this is the limit actually. And actually, with COVID-19, I'm pretty sure everything is working from home. But in terms of compliance, it's going to be very, very difficult to make sure it's working. I can see there is a question from Amadou, and so as for some people says that money is created ex nihilo without any collateral. Can you tell us more about this? So I think it's a good question, and it refers back to the motto I was giving. Is this deposits that are creating credits, or credits that are creating deposits? And so if at the very beginning of the bank industry, so 500 years ago, 400 years ago, it was really deposits. You were able to deposit, you were able to lend some money because you had some deposits. It was because money was made of coins, okay? So it was physical money, it was golden coins. And you couldn't imagine to lend something that you don't have. But now it's fully virtual. And that means that actually if you are a bank And if I am a bank and I have a client telling me, I want to borrow 100, okay? I may not have that money right now. But what I'm sure is I will tell you, well, from the 15th of June, I will lend you 100. And then I will go and see my central bank and I will tell the central bank, I need 100 and I will pay an interest rate for it. So actually the creation of money will start from the client, from the borrower at the very beginning. And the nice thing of banking, of the banking industry right now is as soon as I have lent you some money, I know that you will, at the very beginning, you will deposit it with me. Okay, so this money, I lend it to you and it will come back straight away at the credit of your accounts, but it will be back on my balance sheet. And then maybe you will certainly spend it. So it will go on the balance sheet of another bank, of somebody you will have bought an asset and so on. And this is how the money multiplier is working. So that's how the whole industry is working. Obviously, it's like a mathematical function. So the process of creation of money is limited in time and in amount, but then you would be able to calculate the state of an economy with the speed of the circulation of that money from one bank to another bank, from one guy in the economy to another guy in the economy. And this is so the worldwide economy is actually working with this. So I don't know if I have helped you in that creation of money ex nihilo, but I tried. Otherwise, yeah, we can find another way to talk about it.
We had also another question about how Treasury for banking institutions is different or not from non-financial institutions like a corporate treasurer. How is it different from a bank's treasurer?
Okay, so that's a good one. So the first one, I would say, they have a common view. They need to fund, so they need to make sure that there is enough money to cover the outflows, not only today, but for the coming days, the coming months, or the coming week. So the funding and the liquidity management is the same function for a corporation and a bank. And a bank is a corporation. And so the treasury function inside the bank is working towards the working capital. So it's exactly the same. Now, where you have a big difference is that actually a bank is not only managing its own money, but it's managing your money. And this is where you have the regulators coming into play. And this is where actually it's much more complex to manage a bank treasury than a corporate treasury, because for a corporate treasury, you will have inflows, outflows with different timings, time ladder, maybe different currencies, and that's going to be it. But for a bank treasury, you not only have this, but you have the reserve, you have the capital, you have the way the money and how it is used, you have the instruments, you have the shape of the curve. So the instruments, the underlying assets, which is the money, not only is multiplied with the different countries, the different monies, but it's you have multiple dimensions, which are the curve, so the shape of the interest rate curve. You have the timing, you have the credit risk, who you lend, who you borrow from, and you have the regulators. So it's a 4 or 5 dimension space that you have when you are in a bank treasury, and actually it's moving so fast. Actually, it's it's like everything. It's like Sisyphus rock. It's a lot of time to climb the mountain, but it's when it's going down, it's very, very quick. So as an ex-trader, I can tell you spend days to build a position, to make money, and you make a couple of basis points day after day, and then you have a nice crisis like COVID-19, and you are suddenly losing $500,000 and just like that, And it's exactly that's the work of a treasury. it's amassing money, dollar after dollar, basis point after basis point, and this is a long term job. So this is the difference. So the role of the treasury in a bank is really the profitability of the bank itself, while the role of the treasury in a corporation is really just to sustain the business, but it's not to make money.
Hopefully you can hear me from my end. My Wi-Fi does go in and out. What I found really interesting towards the end of your talk was about the different cycles of innovation that's come in. So you mentioned about mainframes, computers, private networks, and then cloud. What do you think will be one of the kind of next big innovation to disrupt that space? You know, is it looking at how you use AI, machine learning, and risk management? Is it reg tech? There is no right answer here, but what's your thoughts on the next wave of innovation?
Yeah, that's true. There are no right answers, and so Shane, with looking at innovation at Finastra, we had many discussions and brainstorms and thinking about it. And my answer is, I don't know really. You know, it's a very difficult topic. But interestingly, so there is a lot of hype around AI, you know, artificial intelligence, and well, you can think there are a lot of things that you can do. What I usually say is that banks, they have loads of data. They know everything about their clients. They have all financial data, so they know where they spend, when, how much income, and so on. So they know everything. And actually, they are even better positioned than the GAFA, the Googles, and so on. The thing is, they never invested in the analytics of those data. And that's the reason why now you have the Googles and all those monsters that are much better in predicting what you are doing, when you're gonna spend. But it's a bank space. This is where the banks should be. So I think they will invest quite a lot. The biggest bank will invest in that space, and they will try to make it back, to regain what they have lost. So that's my view. And there is an interesting example. It's slightly on the side of what I've said, but so with COVID-19, you have a bank. It's a small bank in Europe. It's called Berenberg, and they wanted to know what to suggest in terms of investments for their wealthy clients. And what they did is they did some research, and they entered in AI machine the word aviation. And what the algo came back with was French banks. So actually, the AI identified that the banks that were most at risk were the French banks, because they were heavily invested in aviation, in Airbus, in Boeing, in sustaining all the companies and corporations that are building planes or that are running airports and so on. And so they advised their clients not to invest in French banks, and obviously not to invest in aviation. But so typically that's a field where banks will increase their market share. They will look at it more. And the second thing is, but it's for some of the bigger banks, they have heavily invested in transaction cost analysis. I think it's interesting to note. For example, I heard that Barclays, they are able to so they've been number one in FX market for many years. It's not anymore the case, but it was the case earlier. And actually, they had algorithms that were able to tell how much money by how much time was made by what type of clients, and what type of price was to be made for the next deal. And just a change in one pip, so 1/10 of a thousand of difference in the FX price was at the end of the day for Barclays, it was a multi-million-dollar profit or loss. So just for 1 pip in effect. So you can imagine that there are big impacts there.
Thank you, Guillaume. I would definitely agree on your point earlier about data. That would be the key for all future innovation, definitely in the banking space. I think we are running over time. That was a really insightful presentation. Thanks a lot. Thank you, Ryan, and thank you to everyone who has joined us today. I just wanted to mention the next sessions that we are having, the next Behind the Hype session. So I think we have at least 3 of them already planned, with a session about blockchain, fintech perspective to blockchain, that would be happening on the 13th of June. Then we'll have a session about women in fintech, where we will hear from fintech founders and leaders. And that's on the 18th of June. And we do also have another session about the evolution, the tech evolution of home buying, that would take place on the 25th of June. So stay tuned, and talk to you soon.
Thank you, everybody. Thanks, Shireen. Thanks, Ryan.